Hello and welcome back to another series of video lectures. In this series of videos, we're going to deal with Chapter 2. And Chapter 2 gets into processing accounting information. Specifically in this video, we're going to look at two main objectives for the chapter. So we're going to look at being able to explain the 5 major steps in the accounting cycle. And we're also going to get into analyzing and recording transactions using that accounting equation. We introduced the accounting equation back in Chapter 1. And remember, the accounting equation states that assets, which are resources to the company, always have to equal liability plus stockholders' equity. And we said that liabilities are obligations of the company, and we said that stockholders' equity were the owner's claims against the company's assets. So let's go ahead and get started, and let's look at the 5 major steps in the accounting cycle. Well, if you notice, analyze and record, we've seen those before, right? We saw those in Chapter 1, and we said, when it comes to accounting, what does accounting involve? Well, we have to analyze transactions, we have to record transactions, and we have to communicate. Okay, so now we're kind of taking a step back and say, okay, what does the entire accounting cycle look like? Well, first we have to analyze. Okay, basically what we're doing is we're analyzing transactions or economic transactions from the company. We use things like source documents. Source documents can be anything from an invoice to a receipt, to maybe loan papers that the bank sends over. Any paper trail or receipts that we have, those are our source documents that we use. Okay, so once we analyze the transaction, we get into the recording cycle. Basically, in the recording cycle, after we have analyzed the transaction, meaning these two accounts are going to be hit, or these two accounts are affected by this economic transaction, we have to record stuff. So we're going to record in a journal. So that's what they mean when they say journalized transactions. We're going to use a journal, and we're going to write the accounts down that are affected, and we're going to debit and credit those. We'll see that a little later in the chapter. But for right now, just know that we have to record, right? We record in a journal. Once we journalize the transactions, we post them to a ledger. And then what we need to do is prepare an unadjusted trial balance, okay? A trial balance is nothing more than a list of accounts with their account balances. That's it. Cash, we have $4 million in cash. Accounts receivable, we have $200,000 in our receivables account. That's all the unadjusted trial balance is. After we record, we're going to have to do adjusting entries. Okay, we'll get into those a little later as well. Again, making adjustments means that we have to do our journal entries. So that's what they mean when they say journalize adjusting entries. We have to post them to the ledger, and then we have to prepare what we call the adjusted trial balance. After we do our adjustments, we can go ahead and report. This is where we communicate. We prepare those financial statements that we looked at in Chapter 1. We're going to prepare the income statement, statement of owner's equity, the balance sheet, and the statement of cash flows. After we prepare those financial statements or communicate the results, we then go ahead and close our books. Okay, what's that mean? Well, again, we have to do journal entries. We're going to journalize our closing entries. We're going to post them to the ledger, and then we're going to prepare a post-closing trial balance. Okay, so this information, and as we're talking, this is going to be over the long run of the course. Okay, in this chapter, we're just going to look at how do we analyze transactions, how do we prepare how do we prepare those journal entries, and we'll get into the unadjusted trial balance. Adjustments we'll see adjustments later. We'll also see the reporting phase a little later. We already got introduced to the financial statements, but a little later on in the chapters, we'll go ahead and actually prepare those financial statements. Mechanically, I'll show you how we put them together. Okay? So let's go ahead and look at how we analyze and record transactions using the accounting equation. Oh, sorry about that. Okay, so this accounting equation, right? Assets equal liabilities plus shareholders' equity. This never goes away, okay? This is the foundation of your accounting career or your accounting classes. We're always going to look at assets equal liabilities plus owner's equity, okay? So what we're going to do is we're going to look at some transactions or some examples of transactions, and we're going to see how each of these transactions impact that accounting equation. Okay, so as we're looking at the transactions, we're going to use, in our project, we're going to use source documents, things like invoices and receipts and whatnot. But for the book problems, they give us like sentences. Hey, here's what happened. We used cash to buy resources, or we used cash to buy assets. But before we can get into that, we got to look at the accounting transactions. And remember, we said that a corporation is separate from its owners, right? So we're analyzing everything from the corporation's perspective. And the economic transaction that we have, or that occurs, has to be recorded within those company accounting records. Okay, we have to put them in the records, meaning we have to journalize them. We have to post them to the ledgers. Okay. When we're analyzing transactions, it's very important to remember that assets, liabilities, or stockholders' equity may be affected, okay? Or they will, at least two of these will be affected, okay? As we go ahead and do our journal entries and we start analyzing and recording, the accounting equation has to stay in balance, okay? Because this assets equal liabilities plus stockholders' equity has to stay in balance, that means that we're going to do double entry bookkeeping, double entry accounting. Double entry accounting says that at least two accounts will be affected. Okay, so keep that in mind. We're always using two accounts. We got to keep this accounting equation balanced. Okay, so what we have here is the expanded accounting equation. Now, this is very, very important. If I were you, I would definitely write this down, study this. You have to know this. A lot of the stuff that we're going to get into, especially in this chapter, chapter 2, and as well as chapter 3 next week, unfortunately, it's all rote memorization. Okay, you just have to memorize this stuff. That's the only way around it. Many years ago when I was learning this, you know what I'd do? I'd put them on note cards, and at least 10 times a day I'd read through the note cards. If I was at work, before I'd sit down and start working at work, you know what? I'd pull out my note cards, read through them real quick. If I had a little break at work, I'd pull out my note cards, read through them. A lot of times in the evening, I'd sit down, relax, watch some TV. Guess what I would do when a commercial comes on? I'd pull out my note cards and I'd start memorizing. I'd keep reading them. So again, I cannot stress this enough. The only way to be successful, you gotta memorize this stuff. Okay. So here's the expanded accounting equation. Notice at the top we still have our assets equal liabilities plus owner's equity or stockholders' equity. Okay, owner's equity, stockholders' equity, it's the same thing. Okay, they're just synonyms for each other. But notice how we break down stockholders' equity. Okay, stockholders' equity is broken down into two main accounts: common stock and retained earnings. Okay, retained earnings is broken down into three accounts: revenues, expenses, and dividends. Okay, so what we're saying here is that common stock and retained earnings, both of those accounts will either increase or decrease stockholders' equity, right? Depending on if we're issuing common stock or we are repurchasing common stock, okay? Retained earnings, same thing. If we have positive retained earnings, our stockholders' equity will increase. If we have negative retained earnings, well, guess what? That will decrease stockholders' equity. Now, retained earnings is impacted by revenues, expenses, and dividends, okay? What we're saying here is that revenues increase retained earnings, which in turn increases stockholders' equity. Expenses decrease retained earnings, which also decrease stockholders' equity. Any dividends that we pay out, guess what? That decreases our retained earnings, and it also decreases our owner's equity or stockholders' equity, okay? Very interesting. Revenues minus expenses. We learned in chapter 1 that revenues minus expenses is our net income. So we can break this down even further and say that, hey, you know what? Net income increases retained earnings. Net loss decreases retained earnings, okay? So again, very, very important that you understand the concepts here of what impacts retained earnings. Revenues increases it, expense decreases it, and dividends decrease it, okay? So the first step, again, in the accounting cycle, hopefully everybody's reading this and says, oh, it has to be B. I got to analyze the transaction first, okay? So let's look at a little illustration of the accounting equation. So Michael Lester established Mike's Bikes. That's really creative there. Mike's Bikes on December 1st, 2016. Mike's Bikes purchases bikes from various suppliers and then sells them to customers. Okay, so Mike's Bikes, it's a retail establishment, right? We're going to buy inventory, then we're going to turn around and sell that inventory to the public. Okay, so what we're going to do is we're going to look at some accounting transactions, right? Keep in mind that as we look at these accounting transactions, they are going to impact the accounting equation. But after we record each of these transactions, the accounting equation has got to remain in balance. It has to. Okay, that's key. So let's look at the first one, and let's see what happens. On December 1st, 2016, Mike invests $30,000 cash in exchange for the company's common stock. Okay, so we just read this and we see that, hey, cash is affected, common stock is affected, right? We don't have to think of, oh, what account do I use? The transaction tells us what accounts we have to use here, okay? So Mike invests $30,000 cash. Cash has to go up. What is Mike getting for giving the company cash? The company is giving Mike common stock. So the common stock has to increase. So if you notice, after this transaction, assets equal liabilities plus stockholders' equity. Let's look at the second one. December 1st, Mike's Bikes prepaid a year's building rent at $500 per month, meaning it paid $6,000. So what happened was Mike took cash, gave it to the landlord, and said, "Hey, here's $6,000. This is the rent for the upcoming year." Okay. What do we have to do? Well, let's think about this. He has a prepaid rent and he has cash. So those are the two accounts that are hit. How did I get that? Well, I just read on December 1st, Mike's Bikes paid a year's building rent at $500 per month. Okay? So my cash is going to decrease by $6,000. What is the corporation or Mike's Bikes company getting for this cash? Well, they're getting prepaid rent. Okay? So we see here that cash decreases by $600, cash decreases by $6,000, rent increases again by $6,000. Notice what happens. After this transaction, the accounting balance is still in effect, right? Or it's still balanced. $24,000 of cash plus $6,000 in prepaid rent equals assets of $6,000. Stockholders' equity is still at $30,000. That did not change. Okay. Let's look at another one, a third example. December 1st, Mike's Bikes purchases $3,000 of merchandise inventory on account. Okay. So don't even worry about the accounting transaction yet. What happened here? Well, Mike bought $3,000 worth of merchandise inventory on account. He didn't pay cash for it. Mike went to his supplier and said, hey, I need to buy $3,000 worth of merchandise inventory. I can't pay you now, but I'll pay you later. Maybe I'll pay you 30 days from now or 60 days from now, whatever. The point is, he bought it on account. The corporation now has an obligation to pay this supplier $3,000 at some point in time in the future. Okay? So, an asset is going to be impacted, specifically merchandise inventory, and the liabilities are going to be impacted. The liabilities are going up by $3,000. So if we look at the accounting equation, again, after this transaction, notice what we did here. We increased merchandise inventory by $3,000, and we increased our accounts payable also by $3,000. Okay? So, does the accounting equation balance? Yep, it sure does. Well, how do you know that? Because I added up all my assets. My total assets equal $33,000. What about my liabilities and stockholders' equity? Well, I take the original $30,000 of stockholders' equity that I previously recorded, and I add my liabilities of $3,000. Assets equal liabilities plus owner's equity. Okay, let's look at the next transaction. On December 1st, Mike's Bikes obtained a 2-year bank loan in the amount of $20,000. Annual interest charges on the note are 6% and are due November 30th. Okay, so let's think about what we did here, right? As of right now, what do we have? Well, we got cash. We got $20,000 in cash. Well, we had to do something to get that $20,000. What did we do? Oh, we signed a note to the bank saying, eventually I'll pay you $20,000. Okay? Annual interest is charged on the note. We have nothing to do with that yet. Okay? We just got the cash. We signed the note. Interest comes later. Right now, what we need to recognize is that our cash increases by $20,000 and our notes payable also increases by $20,000. Okay? After this transaction, we have to add up all the assets. They end up being $53,000. We add up all the liabilities, which is $23,000, plus our stockholders' equity, which is still $30,000. Assets equal $53,000. Liabilities plus stockholders' equity also equals $53,000. Guess what? The accounting equation still holds. Assets still equal liabilities plus stockholders' equity. Okay? Another example. And as we go through these, we are always going to see these, right? A company is always going to buy inventory on account. A company is almost always going to prepay their rent, okay? So what we have here is the purchase of equipment. On December 2nd, Mike's Bikes purchased equipment used for bike maintenance and assembly, okay? So they are buying PP&E, or property, plant, and equipment, that they use to help them generate cash or help them generate revenue. They tell us that Mike uses $15,000 cash from the bank loan, okay? That from the bank loan, we don't need to know that. We don't care that he previously got a bank loan and now he's going to use that money, right? We don't care. We don't need to know that. All we need to know is that he used cash to buy that equipment, okay? So two assets are impacted here, cash and equipment. Cash is going down by $15,000, and our equipment is going to go up by $15,000. Okay. So again, after we do this transaction of decreasing our cash and increasing our equipment, we got to add up all the assets. We got to add up all the liabilities. Got to add up all the stockholders' equity. And we see, okay, does the accounting equation still hold? Well, yeah, it does. Assets still equal $53,000. Liabilities plus stockholders' equity together equal $53,000. Guess what? Accounting equation holds. Okay. Now, let's just say, for example, that Mike decided, hey, I'm going to hire a part-time employee. Okay, cool. So Mike hires an employee. And this, now notice what it says. The employee will be paid $1,000 per month. Did we pay this employee cash? We did not. So this event is not an accounting transaction, right? We just hired somebody. No asset was impacted, no liability was impacted, no shareholders' equity was impacted at the time of this hire. So we just ignore it. This transaction does not enter the accounting equation, and it doesn't enter our accounting information yet. Okay? Guess what? Mike earned some revenue. So the sixth example we have shows that during the month of December, Mike's bike sold 12 grand of bikes for cash. Good for Mike, right? What are we booking here? Well, what was impacted? And again, to determine that, just read what it said. We sold $12,000 of bikes for cash, okay? We need to remember that, well, selling something is helping us generate revenue, right? So we're going to increase our revenue by 12 grand. We're going to increase our cash by $12,000, okay? Then they say that, oh, we're at the end of the month here. Mike's Bikes paid its part-time employee $1,000. So now we have an economic transaction. We used cash to pay our employee who has provided us with their services and worked for us, right? So what happens here is my cash goes down and I need to decrease my expenses, right? Well, why am I subtracting expenses? I'm subtracting expenses because expenses decreases my retained earnings, okay? So I'm going to decrease cash by $1,000. I'm going to decrease expenses by $1,000. So after this transaction, again, I need to go ahead and add up my assets, add up my total liabilities, add up my stockholders' equity, and I need to make sure, does this accounting equation hold? Sure does, because all my assets equal $64,000. My liabilities equal $23,000. And if I add up my stockholders' equity, revenue minus expenses plus common stock gives me that $64,000 that I need. Okay? Okay. So just kind of a quick check here. Purchase supplies on an account. What to account does it involve? Hopefully you said C, right? Because we are increasing an asset, our supplies, but we purchase them on account, so we're also increasing a liability. Okay? When we come back in our next video, okay, we're going to look at the nature, the format, and the purpose of each account that we have, the assets, the liabilities, the revenues, expenses, retained earnings, all that good stuff. But let's not forget about the important takeaways from this chapter, or from this video, really. The first main takeaway is the fact that as we analyze transactions, assets equal liabilities plus stockholders equity, the accounting equation has got to hold, right? Meaning it has to be in balance after each transaction. We said that accounting, specifically what we're doing here, involves double entry accounting, meaning two accounts are always going to be impacted, okay? So if we have an economic transaction, any of the elements of assets, liabilities, or stockholders' equity are going to be affected. Okay? We said this expanded accounting equation, super important, right? We got to memorize this. We got to know that revenues increase retained earnings, expenses and dividends decrease our retained earnings. Common stock and retained earnings, depending on if we have net income or if we're selling stock, that's going to increase retained earnings. If we are repurchasing stock, or if we have a net loss, that is going to decrease our stockholders' equity. Okay, so please tune back in for our next video where we're going to go ahead and look at the accounts, the nature of the accounts.